Hi, welcome to Coffee with Katie. Coffee with Katie is an initiative that I started where I attempt to simplify the financial conversation. I'm Katie Brown. I'm a certified financial planner and chartered financial consultant, and I've had the privilege of serving families for nearly 20 years navigate their financial landscape. So today is all about Roth IRAs, or Roth accounts, I'm going to say. A Roth IRA, and you might also have a Roth option within your 401k, both similar, is where you can contribute to the accounts, and the money that you put into that retirement bucket is after-tax money. So it's money that you've already paid taxes on or that you will be paying taxes on. And then that money grows tax-free and is distributed tax-free. That is different from a traditional IRA or traditional 401k in which you make a contribution and then you take a tax deduction. So you get that tax benefit up front and that money grows tax deferred, but when it comes out, it comes to you as ordinary income. You pay taxes on the full amount, including the growth. So that's the big difference between a Roth and a traditional. The Roth, you get the tax benefit throughout the lifetime, not up front. Now, a Roth IRA, you are subject to income limitations. So if your income is between $198,000, if you're married filing jointly, between $198,000 and $208,000, your ability to contribute to a Roth IRA is phased out, and above $208,000, you cannot contribute directly to a Roth IRA. If you have a Roth option, your 401k, you can still contribute to that though. So definitely ask your employer about that. The reason that I like Roth so much is because, and it's not a perfect fit for everybody, just gonna throw that out there, but as I mentioned, it grows tax-free, comes out tax-free. It's also a great vehicle for somebody to inherit. So if you are in a financial position where you do not expect to spend down all of your assets personally, that is a great vehicle for your heirs to inherit, especially with the Secure Act changes in inherited IRAs where those have to be distributed within 10 years for non-spouse. So if your children, for instance, inherit a traditional IRA, it needs to be distributed within 10 years. A Roth also, but you don't have all the taxes that go along with it. So it's a really great legacy asset. So a couple of strategies around Roths that you may have heard about. You may have heard of a Roth conversion and are wondering what that is and how that works. What a Roth conversion is essentially you're converting a traditional IRA to a Roth IRA. And you want to make sure to work with your custodian, your advisor, and figure out if it makes sense for you to do it. There are tax implications to doing so, because what happens in the background is you're taking money out of the traditional IRA. Whatever money you're converting over, you have to claim as ordinary income. So same as if you receive that money from your employer, you have to pay taxes on that money. But then it gets into the Roth bucket and will grow tax-free and come out tax-free from there on out. But you do have tax implications at the time of conversion. A time when that may make sense for you is if you are in a lower income bracket for one reason or another. Maybe you're transitioning career-wise, maybe you're in the early years of retirement and you haven't started Social Security or pension or other income streams or your required minimum distribution. So you might have a window that makes sense to do some Roth conversions and kind of reposition your accounts. On the other side of that, one other thing that you might have heard about are backdoor Roth IRA contributions. This kind of takes advantage of those Roth conversion opportunities. What a backdoor Roth IRA contribution is if your income is above that $208,000 threshold and you can't make a direct contribution, and let's say you don't have a traditional IRA right now. You might have a 401k and that's okay, but if you don't have a traditional IRA, this is when it works best. You could contribute that $6,000 or $7,000 depending on your age, if you're over age 50, to a traditional IRA and then immediately convert it to a Roth IRA. If your income is that high, you're not taking a deduction on that traditional IRA contribution, so that's after-tax money. And if you convert it right away before you have any growth on that money, then there are no tax implications and you're able to get that contribution into the Roth. So that's what a backdoor Roth IRA contribution is. once again, definitely discuss that with your advisor before you jump into any of those strategies, because there are tax implications and very specific rules you want to make sure to follow. But hopefully this gives you some foundational understanding of what those strategies are. And if you have any further questions or we can help you at all, I would love to hear from you. Please feel free to reach out to me at kbrown@mortonbrownfw.com. In the meantime, take care, and I thank you so much for tuning in.